Hey guys, welcome back to the channel. Recently, I have received a lot of requests from my subscribers to make a complete course on smart money concepts from the very basic to the advanced level. So, I posted a community poll to see if the majority were actually interested. And the poll results were extremely positive. About 90% of all who participated wanted to learn smart money concept. So, here I am, thrilled to present you with this new video course on smart money concept. The course is designed in an orderly manner to provide you with the most comprehensive understanding of the principles and strategies associated with smart money concepts. I'll be taking a very conventional approach, assuming that all of you are complete beginners to this topic. Keeping that in perspective, I will discuss the main concepts in greater detail, which is actually essential to build a solid foundation so that we can have a good understanding about the strategies that we can implement as a trader. This will in turn enable us to plan our proper entries, stop loss and targets, thereby generating high reward to risk trades, which is the highlight of this entire SMC concept. I'm not even joking when I say high reward to risk ratio. We are literally talking about 10:1 or 20:1 or sometimes even a whopping 40:1 reward to risk ratio, which is absolutely insane. And that tells you how powerful these concepts are. By now, I have mentioned smart money concepts numerous times. But what exactly are smart money concepts? I don't want to bore you by giving the same old answer that these are techniques or methods used by large institutions, hedge funds, banks, etc. who are referred to as smart money due to the reason that they make smart decisions in the market, and most of these concepts are purposefully kept away from the reach of uninformed retail traders. But my outlook on smart money concepts is different. I like to view them as traps set by the big institutions to use retail orders, usually the stop loss orders, to generate enough liquidity so as to buy at discount and sell at premiums. Think of these methods as manipulations or stop loss hunting or liquidity grabbing or simply the inducement of retail traders to enter into wrong trades at the wrong time or wrong locations. I know these terms are a little over your head, but fear not, because we are going to deal with all these terms in the upcoming episodes, and I guarantee that you will love it. A lot of research, learning, preparation and hard work has been put into making a very relevant course, and that too absolutely free of cost. I doubt if anyone would take all the pain to make genuine content for my retail trader brothers. So I request you to wholeheartedly like this video and support the upcoming videos also, and share all the episodes with all those who are willing to learn and improve their trading but don't have the money or means to do so. Also make sure to subscribe to this channel because it's free, and also enable the bell icon so that you will receive notifications when I upload the new episodes. So in this video, I would like to give an idea about the course structure and why you should learn these concepts. Then I will answer the evergreen questions like, which is the best market to trade SMC techniques? Will it work in the Indian markets? Which is the best time frame to analyze and trade smart money concepts? Or should we use the multi-time frame analysis approach? But before all that, I would like to take this opportunity to thank Wyckoff theory developed by Mr. Robert Wyckoff during the early 20th century. So you can think how old these concepts are. Actually, the whole Wyckoff method is based on the premise that the market is manipulated by a small group of traders, or so-called the smart money, who have the ability to influence market movements. These smart traders or institutions use their knowledge and resources, which include data about retailer orders and retailer behavior, and they use this information to accumulate or distribute assets before the public is even aware of their intentions. Or in simple layman terms, they manipulate the market to trap retailer liquidity. Smart money concepts or institutional concepts theory is improved by the works of Inner Circle Trader, Tom Williams, Steve Morrow and a few others. Every now and then these concepts are given a new look and some flashy names, but the concept still remains the same. Think of it like companies introducing their old product in a new exciting packaging, inducing you to buy these courses. So I urge you not to spend a lot of money on these expensive courses, because these series of episodes will be more than sufficient to understand the concepts and strategies. But I have an advice. I would like you to watch my courses on price action and supply and demand. The reason why I'm suggesting this is because smart money concepts, price action, and supply and demand theory are all interconnected and have a lot of similarities. It is just the terminology that changes. Most of the underlying ideas are the same. The crux of smart money concept is simply this. Markets are manipulated by big institutions and funds, and they use the liquidity of retail traders against them. Now coming to the second question, why do you as a retail trader need to learn about these concepts? And is it necessary? Actually, I can give an answer to this question in a single sentence. It is just that if you don't know where the liquidity is, then you are the liquidity. Every move in the market is in some way a trap set for the uninformed retail traders. Most of the retail traders blindly follow certain strategies, patterns, and some even call themselves breakout traders while others identify themselves as reversal traders and so on. But until and unless you don't understand how and why a price move was triggered, you will remain as a tiny fish in the ocean being hunted over and over again by the big institution or the smart money. So having a good grab of these techniques can give you a boost to your understanding on how to track the liquidity and how to capitalize on it just like the institutions. You will definitely start thinking differently and view charts with a broader perspective. Because I strongly believe that every move or even each candle formed in the market has a meaning or a logic behind it. If learned and implemented in the right manner, these concepts will definitely take you to the next level. Now, another doubt that most of you might have will be regarding the type of markets in which these concepts can be applied. To be frank, these concepts can be applied on all those markets which have ample liquidity. So, liquidity in simple terms is the ease of buying and selling of an asset without much slippages, meaning that there are enough buyers and sellers available for the smooth transaction of assets. Now, the more difficult it becomes to buy or sell an asset, the asset is said to be less liquid. Now, how do you know if the market or chart you are looking at is liquid or not? Now, there are a few ways to find this out. The most simple method is to look for trading volumes. As you may all know, trading volume refers to the number of shares traded in a particular time frame or period. It could be for 15 minutes or 1 hour or a day or a week. A high trading volume indicates that there is a lot of interest in the stock or an asset and it is highly liquid. With this, we can say that most indices are highly liquid. So to answer your question, these concepts will work well in indices like Nifty, Bank Nifty, etc. But when it comes to stocks, you will have to compare the volume of a stock with its competitors to get an idea. And along with that, we also need to look at the bid-ask spread and the market capitalization of the stock. In simple terms, the market capitalization of a stock is the total value of all outstanding shares. So a higher market capitalization generally indicates a more liquid stock as there are more shares available for trading. On the other hand, the bid-ask spread is the difference between the highest price that a buyer is willing to pay for a stock, or it is called the bid price, and the lowest price that a seller is willing to accept, or the ask price. So a narrow bid-ask spread indicates that the stock is highly liquid as there is a lot of activity in the market and the buyers and sellers are very close in their pricing. But if the bid-ask spread is wide, then the stock is less liquid or there is less activity taking place. So if you are trading in the Indian markets, I recommend you stick with the top Nifty 50 stocks or maybe just select the top 10 stocks that you like from the Nifty 50 range of stocks from different sectors. And if you are a beginner, try your best to avoid mid caps and small caps because the price action may not always be that smooth and sometimes things may not work out. But the best markets to trade smart money concepts are Forex and crypto markets, which are open for almost the entire week, thereby providing a much smoother price action. But this does not mean that all Forex pairs and cryptocurrencies are equally liquid. There is Euro USD, USD JPY, etc., which are highly liquid currency pairs, and cryptos like Bitcoin, Ethereum, etc. are highly liquid. On the other hand, there are other currency pairs like CAD/CHF or PLN JPY, or even cryptos like KuCoin or Gatecoin, etc., which are not liquid. So in short, you can use the smart money concepts to trade Forex markets, crypto markets, indices and stocks, all of which having high liquidity. Now moving on to the second most popular question, which time frame should I choose to trade smart money concepts? To be absolutely frank, we need to follow a top-down approach. That is, we need to start our analysis from the higher time frames or the trend time frames to identify the larger market trend and mark the areas of values, and then move down to an intermediate time frame to spot nested areas of interest for refining our higher time frame analysis, and also to identify the market liquidity, and finally move down to a lower time frame to take a proper entry, set a stop loss, and place a suitable target. Now, SMC technique will work for all trading styles, whether you are a swing trader or intraday trader or BTST trader. It doesn't matter what your trading style is. I have already made a detailed video on how to select the proper set of time frames based on your trading style that you follow. So you can watch that video to know more about multi-time frame analysis. Now finally, let's look at how the entire course is structured. As I have mentioned earlier, we will go in depth into the most important smart money concepts as shown on the screen. Once you become familiar with all these terms and their meanings, we will discuss the application side by learning how to use these concepts for trading in the live markets. That is, how to implement these SMC strategies. We will also talk about the risk management part, where we will learn the entry stop loss combined with the proper exits to plan a high probability, high reward to risk trade. Last but not the least, I will also discuss an indicator that will make things very easy for you so that you don't have to analyze each chart from scratch. With this indicator, you just need to cross-check the validity of the generated SMC signals for trading.
Sorry to interrupt, but this could be important for you. Have you been in a situation where you want to invest your precious savings in the stock market, but there are just too many stocks to choose from and too many gurus giving stock tips? It's risky, and you don't want to take the hassle of reviewing the fundamentals and sweating over the company's performance. Then there are the same old mutual funds. No doubt, mutual funds are great investment instruments, but they are mostly vanilla and less transparent. Introducing small cases. A small case is a ready-made basket of stocks or ETFs which reflect an idea, theme, or strategy. It is just like a supermarket where everything is available, everything is clearly labeled with the right variety and options. Now let's look at a scenario. What, according to you, is the future of the Indian economy? Well, to begin with, the Indian economy is going good. According to some reports, in the coming next 15 years, 45 crore people will be joining the middle class, which is actually huge. This means more buying power. Now, if there is money, then the demand will also increase. So now, what do you think these people will do with the income they're left with after paying for rent and food, luxuries, branded products, travel, and more? With the great Indian middle-class small case, you can invest in all those companies who will benefit from the growing consumer demand. Through just a single product, you can invest in a ready-made portfolio of stocks. Well, that all sounds very great, but then who puts together these portfolios? Small cases are created by SEBI-registered professionals who have an idea or strategy. These guys do all the hard work of selecting stocks and deciding how much money is allocated to each stock. Remember, there are many such small cases and enough options for everyone. What if I need to know more about small cases, like their past performances, their stock selection, or things like that? Small cases present all the necessary information for you to make a decision. You can look at the CAGR, today's change and risk profile. You can see all the stocks and weights and see the criteria behind picking of these stocks, measure past performances of lump sum and SIP. You can also see the news related to these stocks. All you have to do is click invest. And the best thing, when you invest in small cases, you only pay when you transact. There are no expense ratios. It means that the cost is low and investing is easy. Moreover, your stocks and ETFs will show up in your demat account. So what are you guys waiting for? Stop picking stocks that you don't understand. Instead, invest in ideas that you believe in through small cases. The link is in the description. Happy investing. Now let's get back to the video.
Let's say you are a curious kid and you ask me to explain what smart money concepts are in a single sentence. Then I would say smart money concepts are a few methods of identifying, planning, and executing trades on the basis of where the majority of market orders are and what the major market direction is. So in a nutshell, it all comes down to figuring out the market direction and where the major liquidity is there for taking. So as you might have already guessed, the initial step is to identify the market behavior at a particular time period. Or to be more precise, we are interested in identification of a proper market structure so that we can plan our trades based on the dominant market direction. So in this video, we are going to deal with the idea of market structure with respect to smart money concepts. Now, you may ask me, haven't we already discussed the concepts of market structure and market trends in the price action course? Actually, yes, we did. But when it comes to smart money concepts, market structure identification involves a lot more abbreviations, new terms, and stuff like BOS, chalk, strong highs, strong lows, weak highs, weak lows, etc. But the overall idea remains the same. I personally think that with smart money concepts, you will get to understand market structure and its working in a much greater detail. And in addition to this, we will also get a clarity on the major market structure and the minor or internal market structures. And we will also talk about the nature of pullbacks for both these structures. So let's get going right away. Now, you may be familiar with the fact that a liquid market or a stock or any asset goes through several market phases. Majorly, the accumulation phase, the markup phase, the distribution phase, and the markdown phase. Now, there can also be sub-phases like the reaccumulation or redistribution phases. But my point is that even though there are several phases of the market, the overall market structure boils down to three main stages or trends, namely the uptrend structure, the downtrend structure, and the sideways or range-bound market structure. Now, as you may already learned from the price action course, an uptrend is characterized by higher swing highs and higher swing lows, while downtrend forms when price forms lower highs and lower lows. And when it comes to sideways market, there is no clear trend or price action, or simply the price remains within a range. Now, this is a very basic way of understanding market structure and trends. But in this video, let's build on top of this basic idea. So in smart money concepts, we are mostly interested in trending price action when compared to sideways or range-bound price action. But this does not mean that we can completely avoid sideways ranges. And it is not the right way to think about it. Because further forward in this course, we will definitely talk about how to deal with or trade on range price action. Meanwhile, let us now focus on the two main structures based on SMC technique. Now, these are the bullish market structure and the bearish market structure. So think of a bullish structure as an uptrend with many more constraints. And on the opposite, think of a bearish structure as a downtrend, but with a lot more constraints or factors to consider. First, let us take a look at a typical bullish market structure. And yes, you are right, we need to look for higher highs and higher lows. But market structure is not always that easy to identify. It is more complicated and challenging than we think. I personally believe that if you get this particular step right, then you will be able to get most of your trade analysis correctly. In fact, this is the step where most people make mistakes. So when you commit a mistake at the start of your analysis itself, then naturally the rest of the process will obviously amplify the initial mistake, and finally you will be left with a corrupted and incorrect analysis in hand. And guess what? All of this will result in a wrong trade at the wrong time and the wrong location, with you making huge losses. And at the end of the day, you will have no idea where things went wrong. So my request is that you strengthen your basics first. Now with that out of the way, let us understand a bullish market structure. See, as mentioned just now, market structure will not always be very easy to identify and mark. Sometimes it can be confusing and complicated. Take a look at this chart. At a single glance, can you determine the overall market structure? Well, most of you would not be able to. Actually, this is a bullish market structure. And why do you think you are not able to identify this? The simple reason is that your eyes are not trained to look for specific details. Let me explain this. Now, you might have learned that market moves in the form of waves, and during a trending move, there is an impulse move and a corrective move. This is true, and I don't have any problems with this idea. But what needs to be added in this context is that a market structure comprises of two structures. That is, there is a major structure and there is a minor or internal structure. And as the name suggests, the major structure is the dominant structure, or it is the major structure that determines the dominant player in the market. Now, the minor or internal structure is the less important structure that gets formed within the major structure. So, if you are planning to be an SMC trader, then you should train your eyes to spot these major market structures in comparison to the minor structures, because it is the major structure that majority of our trades will be concentrated on. Now, you may ask me which time frame we should look for the major structures. Now, we will get to this topic of time frames in a later on video, but for the time being, keep in mind that we have to look for the major structures on the higher time frames for our analysis. You can check out my detailed video on time frame selection to learn more about how to select proper time frames based on our trading styles. Moving on, let's learn how to map the major market structure and also discuss what the breakout structure and change of character is. Now, this is important because it helps you confirm the major swing points. That is, it lets you confirm the higher highs and the higher swing lows in a major bullish market structure from the minor swings, which actually behaves like noise in our analysis. Similarly, it can help to confirm the lower swing highs and the lower swing lows in a bearish market structure from the minor or internal structures. Now take a look at this. The market momentum is bullish. The market created a low and a high. Then the price made a retracement or a pullback. Then once again, the price moves higher and breaks and closes above the previous high. Now this is called a break of structure, or simply BOS, or spelled as BOS. It is also called as a continuation break as the price resumes in the major trend direction. So technically, a bullish break of structure happens when the price breaks and closes above the previous swing high or the higher high. Please do note that the price has to close above the previous swing high level for this to be considered as a valid break of structure. Just a liquidity sweep or simply a false breakout associated with a long wick does not qualify as a break of structure. In addition to this, only when a bullish break of structure happens, then only the higher swing low level is confirmed. And as you may know, a higher low is the lowest swing point, which is higher than the previous swing low level in a bullish trending market structure. Now, what happens after a bullish break of structure? How do we confirm a higher high? Now, listen to me carefully. Price rarely moves in a straight line. If you observe within a larger trend, there are almost always counter trend moves. These counter trend moves are the results of lower time frame liquidity hunting. So once the price bounce or get rejected from a level, then normally it will target a previous short-term high or low before continuing in the same direction as the longer-term trend. And for some of you, this might be a very new concept. And by the way, this is called as an inducement, which is a very important topic in SMC. And we will discuss this concept in our upcoming episodes. And once we get used with all these small topics, we will combine all these concepts to finally understand what a true SMC structure looks like and how it works in a very practical manner. But for the time being, let us go ahead and understand how a higher high of a major bullish structure gets formed using a concept that most of us are already aware of. It is none other than pullbacks. So the price breaks the previous high and it moves higher, but it cannot go higher indefinitely. At some point, it has to come down, which we call as a corrective move. So we can say that a bullish market structure is a combination of bullish impulse moves and corrective pullbacks. Now you can ask me, do all these pullbacks or corrections matter? The answer is no. We are more interested in those deeper pullbacks. Now, how do we know if a pullback is deep enough? For this purpose, we can make use of the Fibonacci retracement tool. So a deeper pullback is a retracement that goes beyond the 38.2% to 50% or even lower Fibonacci levels without closing below the previous swing low or higher low levels. The reason why we require a deeper pullback is because there is a lot of liquidity available below these internal pullback levels. And for the market to make a meaningful move, it has to tap into these retailer orders and then use these orders as a fuel to move higher. This is a very simple explanation of a much complicated concept. I hope you guys have understood what I'm trying to explain. Anyways, once we have identified a deeper pullback using Fibonacci retracement tool, we can now mark the highest point after the previous break of structure as the higher level. And now once again, if the price moves higher and if it manages to break and close above the recent higher high formed, then again we have a bullish break of structure. And this step will confirm the higher low level, which is in fact the deepest pullback before the break of structure has happened. So in short, a new higher high is confirmed only after a deeper pullback has happened, which will actually sweep all the previous retailer liquidity below the internal or minor swing lows. And on the contrary, a new higher low is confirmed only when a valid bullish break of structure happens. Now what happens when the market fails to make a new higher high? That is, the break of structure fails, but instead the price breaks and closes below the previous higher low level. So if you have watched my price action course carefully, then you know that this is the first sign of a change in the market structure from bullish to bearish. Or in other words, we can say that this is the start of a new trend reversal. And in smart money terms, this shift in the market structure is called as a change of character or simply chalk. But do keep in mind that the price has to break and close below the previous higher low for the chalk to get confirmed. This is very important as many traders make mistake in this part, as just a liquidity sweep or a false breakout with a deep wick projecting below the higher low does not qualify. Once a change of character takes place, we will now focus our analysis towards the formation of either a bearish market structure or a sideways market structure. We should consider the possibility of both these structures until and unless we get a solid confirmation for the continuation of the bearish market structure. Let me explain this in greater detail. We know that during a downtrend or a bearish market structure, we expect the price to form lower swing highs and lower swing lows. So if you want to be an SMC trader, you have to train your eyes to find these important levels. But trust me, it is not as easy as you think. Because in most trading textbooks, we will find a very simple and straightforward method of identifying market structures. But in real market scenario, it is much more complex. So listen to me carefully. In order to confirm a lower low in comparison to the previous swing low, the price has to do a pullback. Not just any pullback, but a deeper pullback, taking out the liquidity of the previous internal swing high levels. Now you can identify if it is a deeper pullback or not by using a simple Fibonacci retracement tool and check if the pullback is over 38.2% or 50% or even higher levels. But as long as it does not break and close above the previous major swing high level, we are okay with it. Now what is the significance or maybe what is the logic behind wanting a deeper pullback? Now the logic is quite simple. And it is associated with the retailer mentality. So as a retailer, what will you do when you spot a breakout or a breakdown? Obviously, you will take a trade in the direction of the market break, right? Now, where will you place your stop loss? Quite clearly, you will place it beyond the breakout level. So in case when a retailer sees a bullish break of structure, most probably he will place his stop loss below the previous minor swing low level. And if we spot a bearish change of character, he will take a short position and he will place the stop loss just above the previous minor swing high level, right? Clearly, these swing levels just before a breakout or a breakdown, or in other words, these swing levels just before a break of structure or a change of character have a lot of stop loss orders available. These stop loss orders are in fact retailer liquidity, which the smart money is so keen to exploit. And these clusters of stop loss orders helps the smart money to buy low and sell high. Now coming to the reason why these deeper pullbacks are important. It is quite evident that these deeper pullbacks are actually searching for retailer liquidity, and once the liquidity is absorbed, the market usually tends to continue strongly in the major trend direction. So we have to look for a deeper pullback after a change of character has taken place so as to confirm if the low formed is actually a lower low or not. Don't worry if you have not understood this concept completely. You can either watch this concept multiple times, and still if the doubt persists, you can wait for the upcoming episodes where I will talk about inducements, order blocks, etc., so that you will get a deeper understanding on the smart money concept structure mapping. Now moving on, after the deeper pullback, taking out the retailer liquidity and confirming a lower low, the price moves lower and it breaks and closes below the recent lower low level. This is called a bearish breakout structure, or simply BOS. I'm stressing the point that the price needs to break and close below the previous low level to confirm a valid breakout structure. Just a liquidity sweep or a false breakout with a deep wick projecting below the lower low level won't count as a valid breakout structure. Now, only when a valid breakout structure happens can we actually confirm the lower high level. So long story short, a lower swing high is confirmed only when there is a valid bearish breakout structure. And on top of that, the lower swing high is the highest point before the BOS and the previous lower low level. And all the other swing highs are just the internal or minor structures, and we don't have to give much importance to these. As an SMC trader, the major structure matters to us the most, and we conduct the analysis for our major structure on our higher time frames to get the best possible results, because in the lower time frames, charts are more random and noisy. Now once again, the price has to search for liquidity in these intermediate or internal swing highs, and in doing so, it forms a deep pullback which sweeps the liquidity in those levels and then moves lower. Now once the liquidity is absorbed by a deeper pullback, which can be measured using a Fibonacci retracement tool, we can confirm the new lower low level. Then again, the price has to move lower and break and close below the new lower low formed to confirm a valid breakout structure, and in turn, the highest point before the BOS and lower low will be marked as the new lower high level, and this process continues until the price fails to break and close below the previous lower low level, and instead it breaks and closes above the previous lower swing high level. Now what does this indicate? This actually signals a change in the sentiment, or it can be thought of as the first indication of a reversal. That is, the trend might change from bearish to bullish. So this shift in the market structure is called as a change of character. So now we have to change our perspective and we have to look for a bullish structure or a sideways market structure. And by now, you might already be familiar as to how to identify a bullish market structure, right? But hey, I haven't talked about the sideways market structure, right? But you may already be familiar with the accumulation or distribution phases from my price action video. These are phases where the market takes a break or where the big institutions start building their position, which is actually represented by the accumulation phases, or where they start selling their holdings, which is called as the distribution phase. Anyways, the sideways market structure can be any of them. Think of it as market taking a pause or a breather. And only when the price breaks and closes above or below the constraints of this phase are we really interested in making a move. So as an SMC trader or a price action trader, it is always ideal to wait out the sideways market and focus more on the trending market phases for your trades. Now before I finish this episode, I have to discuss a few more terms like strong highs and strong lows, weak highs and weak lows, etc. Now these are just additional information which is built on top of what we have already learned in this video, and it's nothing new. So a weak high or a weak low refers to those swing highs and lows which have a greater possibility of getting swept. So for example, a higher high is considered as a weak high as it has a good possibility of getting taken out by a bullish breakout structure. And similarly, a higher low is considered as a weak low as there is a good chance that a change of character can take out this higher low. On a same note, during a bearish market structure, a lower low is marked as a weak low as there is a good chance that it can be taken out by a bearish breakout structure. And similarly, a lower high is considered as a weak high as it can be easily taken out by a change of character. So in short, a weak low or a weak high has a greater chance of getting taken out by the market. Contrary to this, strong highs and strong lows are those price levels which are not easily taken down by the market. So typical examples of this are the higher highs just before a change of character, meaning that the market was not able to take out the higher high level, which makes it an important level for future price analysis, as it could play the role of a potential resistance level in the future. Similarly, a lower low just before a change of character is considered as a strong low for future analysis because the market was not able to take out this level, and it can act as a meaningful support level in the future. Now, other than these, there are equal highs and equal lows, and as the name suggests, they have same high or low levels. Now, we will understand the significance of all these as we move along this course. But I think this is enough for this particular video. And after a few more episodes, we will revisit this topic once again. But then we will discuss the topic completely using relevant charts, be it Forex charts or Nifty or Bank Nifty charts. Anyways, I would like to end this video by mentioning that market structure makes up the backbone of the market, and it is essential in understanding if you want to be able to read the market more precisely and clearly so as to be able to trade in it successfully. In the previous episode, we have understood about the market structure mapping in great detail. In this video, I would like to introduce you to a completely new topic. It is known in different names in SMC, be it fair value gaps, imbalance, inefficiency, etc. But the overall concept remains the same. What you need to keep in mind is that such imbalances in the market happens due to irregular or disproportionate price movements. These price movements may deviate from what is considered normal or expected based on historical price patterns, fundamental analysis, or technical indicators. Such inefficiencies or imbalances can create potential trading opportunities for both investors and traders. But imbalances in price behavior can take different forms. Just think about it. Could be in the form of gaps, volume imbalances, spikes, lack of liquidity, displacement, etc. Now, I will try to explain each one very briefly to get a general idea of what is what. Let's start with gaps. Price gaps occur when the opening price of a candle is significantly different from the previous candle's closing price. So, a gap has a complete absence of trading activity between two candles. Now, these gaps can be caused by various factors, such as overnight news, earnings reports, or other market moving events. And gaps can be of different types. It can be breakaway gaps, runaway gaps, exhaustion gaps, and professional gaps. Depending on the type of gap, you can choose to adopt a particular strategy to capitalize on the imbalance. I have already made a detailed video on gaps and how to trade them in my complete price action course. You can check that out to learn more. Next up is volume imbalances. A volume imbalance is a gap between the closing and opening price of two candles and the difference in between. A volume imbalance, in fact, has a trading activity happening, or there is an overlap between the high and low prices when compared to a price gap. Now, a quick example of a volume imbalance would be from this closing price to this opening price, and also we have a gap. However, the price did manage to trade through these areas, so it is indeed a volume imbalance and not really a price gap. Moving on, price spikes refer to sudden and sharp movements in a security's price, often resulting from an unexpected event or a large surge in trading volume. Now, these spikes can be caused by different factors such as market orders, stop loss triggers, or algorithm trading activity. Now, in some cases, low trading volume and liquidity in a particular stock can lead to inefficiencies, as it may result in a wider bid-ask spread and difficulty in executing trades at desired prices. So traders need to be cautious when dealing with illiquid stocks, as it can be challenging to enter and exit their positions without causing significant price impacts. Now, all these are in some form or the other a type of imbalance in the market. But when it comes to smart money concepts, we are only concerned about the imbalances caused due to displacements. So displacement, in short, is a very powerful move in price action, resulting in strong selling or buying pressure. Generally speaking, displacement will appear as a single candlestick or a group of candles that are all positioned in the same direction. Now, these candles typically have large real bodies with very short wicks, which suggests that there is a very little disagreement between buyers and sellers. Or, in other words, only one party has a clear dominance over the other. Most often, a displacement will occur just after a liquidity level has been breached, where there are clusters of orders, and this will often result in the creation of both a fair value gap and a market structure shift. Now, we have already discussed market structure mapping and terms like BOSS, chalk, etc. in the first episode. So make sure you have a proper knowledge of the same. But right now, what we are concerned about are fair value gaps or inefficiencies or simply imbalances. So after the price reaches a particular liquidity level where large numbers of orders are accumulated, and when price reverses after absorbing the liquidity from this area, often what will come next is displacement. So these fair value gaps are usually created within these displacement moves, which means that these are instances in which we can spot inefficiencies or imbalances in the market. I have talked about liquidity levels where most of the orders are accumulated. But how to identify these levels? There is a simple rule to spot these areas. So, the last bearish candle or selling momentum before an up move is referred to as a bullish order block, where a large number of buy orders are assumed to be located. Similarly, the last bullish candle or the last buying momentum before a down move is referred to as a bearish order block, where a large number of sell orders are assumed to be clustered. Just keep this in mind and don't stress a lot because we will learn all this in great detail in the upcoming episodes. Now you can ask me, why is an imbalance or fair value gap for that matter considered as an inefficiency? The reason is simple and straightforward. When price moves strongly in one direction, and that too by means of large-bodied candles, there is a clear discrimination between the buyers and sellers. Let me explain. Imbalance, as the name suggests, is an area of unequal market moves where there are only buyers or only sellers which exist in the market. The reason we call this an imbalance is not only because it is an imbalance between buyers and sellers, because there is literally an imbalance in the market. Trading volume is tilted either towards the bid or ask side too quickly, so there are still a lot of unexecuted orders in the market. So if we have an impulsive move to the upside, it is because there are no sellers to absorb the buying pressure of the bulls. This means that there is no resistance from sellers to stop the buyers from pushing the price up rapidly. On the other hand, if we have an impulsive move to the downside, it means there are no buyers to absorb the selling pressure of the bears. This means that there is no resistance from buyers to stop the sellers from pushing the price down rapidly. Simply put, imbalances occurs when there are many orders of the same type, be it buy, sell or limit orders, and also a lack of liquidity or counter orders in the market. For example, if there are many more buyers of a stock than sellers, then the balance can tilt in the favor of buyers. And on the chart, this imbalance looked like a price gap within which only a part of the volume has been traded. This is an unhealthy price action because it shows the disequilibrium between buyers and sellers. So an imbalance means unfair price action where the market will almost always come back to fill. Another thing to note is that the wicks do not fill each other. And if they do, then it is healthy price action or efficient price action and not really an imbalance. So to put it simply, market inefficiency occurs when the wicks are separated by a distance or a gap and they do not meet. While an efficient market, on the other hand, is one in which the wicks do not have a gap between them and they actually meet. This brings us to the next important point. How to identify or spot an imbalance or a fair value gap within a particular displacement move. To be absolutely clear, an imbalance can be defined as an imbalance between buyers and sellers. So a bullish imbalance has more buyers behind it, and obviously a bearish imbalance has more sellers behind it. So when you see an impulsive move to the upside or downside in the market with no wicks overlapping full-bodied candles, this is where imbalance in the market are formed. These can happen on all time frames. Now, when looking for an imbalance in the market, simply look for any candle which has a full real body and look for the part of this candle that is not overlapped by the previous and next candle's wick. This signifies an imbalance in the market because there were only a few transactions going on between buyers and sellers. We can clearly say that one party has overpowered the other depending on the direction of the price. Now, if you think about it, wicks usually represent price oscillating up and down within the time it takes to print an entire candle, showing that the price is efficient because there were continuous transactions happening between buyers and sellers. So it shows us that price is giving both buyers and sellers a fair chance at accessing the liquidity. So when the wicks meet, it provides the buyers and sellers an access to get into the market and profit on the price move. But on the contrary, when you see a full-bodied candle with no wicks overlapping it, it is obvious that you have identified a clear imbalance in price. This may seem very complicated and over the roof, so let me break this down further and help you understand it better. Now, a very simple method to keep in mind is to think of a fair value gap as a 3-candlestick pattern where the first candle's low does not overlap with the third candle's high in case of a down move, or where the first candle's high does not overlap with the third candle's low in case of an up move, with the condition that the middle candle has to be a large-bodied candle with little or no wicks. But there can be some exceptions to this rule, which we will look at. But first, let's take a deep dive into this concept. As I have mentioned just now, these imbalances on price chart are visualized by a 3-candlestick sequence containing one large middle candle whose bordering candles upper and lower wicks do not overlap. Now take a look at this example. The middle candle is a large bearish candle with little or no wicks. Now number the candles as 1, 2 and 3 from left to right. Then consider the first candle's low and mark a horizontal line out, and do the same for the third candle's high and extend out an horizontal line. You can notice that there is a clear gap between the wicks on the first candle and the third candle, and the wicks do not meet or the high does not overlap with the low. Therefore, this can be identified as an imbalance or an inefficient price action or simply a fair value gap. Now consider another example. Here the middle candle is a large bullish candle with little or no wicks. Now number the candles as 1, 2, 3 from left towards right. Then extend a horizontal line from the first candlestick high and do the same from the third candlestick's low. And you can clearly notice that the high and low wicks do not overlap with one another. So we can say this price action is inefficient or not healthy. So this is a fair value gap. Now let's take a look at some of the tricky situations which you could encounter in the charts. On some occasions, you will not be able to apply this rule directly, and you might need to focus on some more important factors before plotting a fair value gap. Observe this over here and tell me, how will you mark the imbalances in this case? So if you look at this diagram, this candle here is our last bullish candle or the last buying momentum before the price drop. So most of you will mark this bearish candle's low, which formed after the last bullish candle, as number 1. And some people might even mark the bullish candle's low as number 1 and then mark the third candle's high. Now, in either case, this is not a valid imbalance. And why is it so? If you look at the left side, there is a bearish candle before this up move. And you will notice that the high and low of this bearish candle is protected, meaning that the candle's high and low are not broken by the up move. So if the market creates anything between the high and low of this bearish candle, all those moves are considered as internal moves only. So in such scenarios, first of all, you have to check if the previous candle's highs and lows are broken or not. Then only you have to number the candles as 1, 2 and 3. So here, this bearish candle has to be numbered 1 and this candle's low is to be marked or extended using a horizontal line. The next candle which has broken the bearish candle low is our second candle, and finally, we will also mark the high of the third candle. Now this becomes our valid imbalance, which the market might return to fill or absorb. So keep in mind that internal price moves are not to be considered while marking proper imbalances. Now a lot of people will wait for the price to fill this particular imbalance and they will look for short trading entries. But this is not a valid imbalance. This would have been a valid imbalance if the market would have broken this bearish candle's low. So now the bearish candle is no longer considered. Now when you mark the imbalance, you can consider the bullish candle's low and number it as 1. But the next bearish candle is not taken into account because it is an inside candle which was unable to break the highs and lows of the bullish candle. So our second candle in this case would be this bearish candle which has broken the low of the bullish candle, and then the third candle high is also marked, and the difference will become our imbalance. Now there can be another scenario when the high of the last bullish candle has been broken. Now how will you mark the imbalance in this case? So here, this bearish candle is no longer an inside candle, and thus we can number it as 1 and mark its low, and subsequently we can number the other candles as 2 and 3 and mark the high of the third candle, and thereby we can observe the imbalance. I hope you guys have understood all these different scenarios. Now, I want you to mark the imbalances for these 3 scenarios on your own. Just pause the video and do it by yourself. The answer will appear on the screen after 5 seconds. So try it right away. So now that you have understood what a fair value gap looks like, let's also make sure what it does not look like. Like before, extend a horizontal line from the first candle's low and another line from the third candle high to see if there is a gap. When dragging the high and low across, you can see that they overlap. This means that the low from the first candle is lower than the high from the third candle. So there is no gap or inefficiency there. And thus this is not a fair value gap. Similarly over here, if we were to extend the first candle's high using a line and also extend a line from the third candle's low, you can see that there is an overlap between the first candle's high and the third candle's low, meaning there is no imbalance or fair value gap. So now just to clarify, a gap between the first candle's low and the third candle's high, or the first candle's high or the third candle's low, is what creates a fair value gap. Now I want you to find such imbalances or fair value gaps on different charts and mark them on your own by this simple method. The next thing we are going to look at are CBs and BCs. These are nothing new, it's just the same concept in a new name and packaging just to induce curiosity. So a CB stands for a sell side imbalance and buy side inefficiency. What does this mean? It means that the sell side was offered but the buy side wasn't. So it is inefficient. Or simply put, it represents a bearish fair value gap where the bears have overpowered the bulls. It is also known as undervalued fair value gap. What it means is that the price of the asset is lower than its fair value gap. In this case, the price might increase in the future to balance this inefficiency in price. Now, a BC stands for buy side imbalance and sell side inefficiency. This means that the buy side was offered, but the sell side wasn't offered. So it is inefficient, or it represents a bullish fair value gap where the bulls have overpowered the bears. It is also known as overvalued fair value gap. What this means is that the price of the asset is higher than its fair value gap. Now in this case, the price might decrease in the future to balance this inefficiency. So if we look at this price action right here, we have a bearish fair value gap where the sell side is offered, but the buy side is inefficient. So this creates a CB. Now if you look over to the right, you can see that the price has made a bullish fair value gap or a BC because it offered the buy side but not the sell side. And that's all about BC and CB, and I hope that clarifies some things for you guys. Now another relevant question worth asking is, why do market imbalances occur? The emergence of persistent price imbalances in one direction after long periods of stable or efficient pricing indicates that institutions are accumulating positions. Now, these institutions can be funds, banks, and other financial institutions that we call smart money. But do keep in mind that the market is influenced not only by institutions, but also by market makers, investors, and traders with large capital. For example, smart money can place many orders and then modify or cancel them to bring the market back to an equilibrium state. These market makers, traders, and investors can oppose each other, and they can also act in the same direction. In most occasions, imbalances in the market can occur after the release of an economic or geopolitical news. The reasons can vary on whether you're dealing in forex or in other markets. It could be the publication of financial statement. For example, a very positive quarterly report can lead to an imbalance towards buyers. Similarly, it can be corporate announcement of bankruptcy, management changes, takeovers, business purchases, etc. It could also be governmental and regulatory actions, interest rate changes, etc., which could contribute to the imbalance. It could even be political problems, natural disasters, etc. Now, since you have understood what a fair value gap or imbalance is, now you can ask me, how is it useful for traders like you and me? Now, as mentioned earlier, imbalances in the market can be viewed as inefficiency in price behavior, telling us that maybe banks or big financial institutions are involved in the aggressive movements of prices that we are seeing. Again, if you think about it, most impulsive moves and imbalances in the market happen as a result of there being no liquidity in the form of counter orders to stop the price from being met with resistance and thereby slowing down. Now, if you consider an efficient market, we get to see the price trade within a range of fair value for that particular asset, where the sellers will sell when they perceive that the price of the asset is high or the price is trading at a premium, and the buyers will buy when they perceive that the price of the asset is low or is trading at a discount. This is not the case of an inefficient market. The big institutions will create a high momentum move and an imbalance in the market that is much like a gap in price. In most cases, this price manipulation can be a part of institutions' plan to generate liquidity to buy low and sell high, and therefore we may see the price coming back to fill that imbalance or close the price gap before pushing back into the same direction that the price made the impulse move from. And now, to answer the question, how can we as traders benefit from such imbalances? Imbalance is a type of trading opportunity for both intraday and swing traders. In trading, imbalances are used to identify zones of interest. We will talk about these zones of interest, which is more commonly known as order blocks, in the upcoming episodes. The zone from which the imbalance originated is characterized by a higher level of probability. This zone is suitable for analyzing and identifying potential trade entry points. The entry points can be selected with the help of technical analysis within the selector trading methodology. In this case, imbalances act as an additional factor in favor of the trade. So naturally, most imbalances in the market represents an inefficiency in price, and therefore there is usually a good chance that the price will return to fill that imbalance in order to make the price efficient again. Now, I cannot guarantee that the price will always come back to fill the imbalance, but in most scenarios, the price will return to fill the imbalances that form in the market. Because it is a rule of nature that everything wants to come to rest or to be balanced. In the same way, the price also wants to remain in balance. So when an imbalance is created, the price tries to balance it. And the imbalance gap between the wicks of the neighboring candles acts as a price magnet. It means that as the liquidity fills, the price will close the imbalance. This is what we call as mitigation in smart money concepts. Or when we say that the price has mitigated the imbalance, it means the imbalance has been filled and efficient price action has been restored, and the market will most likely continue in the direction of the impulse move. But do keep in mind that mitigation is more a general term, which can be used to indicate a filling of a price gap, filling of an order block, etc. We will talk about this topic in more detail in the upcoming episodes of this course. As you are aware by now, imbalances represent price inefficiency. Therefore, there is a high probability that the market will come back to fill the imbalance. For example, if a large bidder has manipulated the market, a correction might occur afterwards. Typically, price tends to mitigate the imbalance or the area from which it originated. Therefore, we can look to take a trade in the direction of the imbalance in order to profit from the price movement. In this way, we will be able to buy low and sell high like the institutions. However, there are times when the price will just continue to push back against the imbalance that are forming in the market. I won't go deeper into the trading aspects of this concept in this video. We will discuss different SMC trading techniques once we have covered all the basic concepts that guides the SMC theory. Now, I want to talk about some advanced concepts regarding fair value gaps. I won't force you to learn these, but it is worth knowing as it would help you to trade with better conviction and accuracy. Now, there are three things to look out for within a fair value gap. The first being the start of the fair value gap, the second being the consequent encroachment or the 50% of the fair value gap, and lastly, where the price completely fills the fair value gap. We can make use of the Fibonacci tool to mark these levels within these fair value gaps. When the price returns to the fair value gap, we should look for a few different things. This will give us a better idea if the fair value gap is respected by the price or should it be considered invalid. I will be considering a bearish fair value gap or a CB for this purpose. So first, the price can either reach up into the fair value gap but close outside the fair value gap and continue lower. Price can also reach up into the consequent encroachment or 50% of this fair value gap. In this case, we would like to see the candle close outside the fair value gap, but as long as the price is respecting the consequent encroachment, we can be pretty flexible with the price closing just below the consequent encroachment. Sometimes the price can also reach up to fill the fair value gap, and in such cases, it is preferable to see the price closing outside the consequent encroachment of this fair value gap. The most important thing to look for when invalidating a fair value gap is where the price closes. So when the price starts to close over the consequent encroachment or outside of the fair value gap, it is an indication that the price is not respecting the fair value gap, and most of the time, price will not reverse back down and the CB is deemed invalid. Now let's look at a few examples to understand this concept better. So we have a CB right here. Let's mark out the consequent encroachment using Fibonacci tool and see what happens. So you can see when price reaches up into this fair value gap, does not close over the consequent encroachment, or in other words, price respects the fair value gap and it is still valid for a reversal to happen. Now let's take a look at another CB right here. Let's mark out the consequent encroachment. You can see that the price did not respect the CB at all and closed right through it. This is when we will invalidate a fair value gap because the price is not respecting it. Now, if you look at a busy or a bullish fair value gap right here and mark out the consequent encroachment to see what happens. The price reaches into the fair value gap and closes out. So it is currently respecting the busy and it is still deemed valid. Another case is when the price breaks out and closes below the busy, and in that case we can confirm that the price is not respecting the busy and it can be regarded as invalid. The next thing we are going to look at is fair value gap inversion. To explain this in simple terms, inversion happens when a fair value gap fails or when the price closes through it, and then this fair value gap can be used as a support or resistance for future price movements. What this means is that I would expect price to return back to this old CB to use it as support and move away. Similarly, price could return back to an old BC to use it as a resistance and then move lower. Another thing to note is that this does not have to happen back to back, meaning that this can occur later on after a period of consolidation. Let's look at some example to clear things up. So we have a CB right here and the price closes through it. So it is considered invalid. But that does not make it useless. We can then look to see if the CB supports the price. And we can clearly see that this old CB acted as a support for prices before getting a move higher. Here's an example of what I mean when I say that the fair value gap inversion does not need to occur back to back. So we have considered another BC, and right here we get a close below this fair value gap. So it is deemed invalid. Now let's see what happens when price returns to this old BC. You can see that the price returns to this old BC. It uses it as resistance to go lower. But this did not happen suddenly, and the price took a while to return back to this BC. For our next example, we have a CB right here. So let's see how the price reacts to it. And you can see the price has filled this fair value gap, but the price closes out of it. So it is currently respecting this CB. But right after this, we can see that the price closes over this CB, invalidating it. Now let's see if an inversion happens when the price returns. And you can clearly see how the CB was used as support and the price returned. So I think that clears a lot of questions regarding imbalances or fair value gaps. You need to be aware that imbalances in chart create the fuel for the uptrending price movement. However, you should not mindlessly enter a trade in an imbalance zone. It is necessary that you use strong confluences, and it is also necessary to monitor the context and make decisions based on it. In this video, we will discuss the most important concept in the whole smart money concept approach. Or maybe it is one of the keystone topics when it comes to trading as a whole. It is none other than liquidity. We retail traders like to get things done the easier way. Therefore, we usually focus on indicator signals for taking trades. We are least bothered about why the price moved in a particular manner that triggered the indicator to give a buy or a sell signal. Almost all indicators are derived from fundamental elements of the market, which are price and volume. Further, price and volumes are a result of the post-processing of basic market data. So the point that I want to elaborate is that indicators can to some extent do a good job in generating winning trades. But most indicators fail to work in all market conditions, and the signal provided by a single indicator cannot be trusted completely. And to top it all off, almost all indicators are lagging in nature, and they give a trade signal after the move has already started, which result in more risk and thereby lowers your reward to risk ratio. So one way to stay on top of the market is to play the game like the market makers, big institutions or banks, or simply the smart money who feeds on the retailer orders to make a living. The big price moves or momentum moves that you witness in the market are a result of the smart money trapping the uninformed traders, or should I say the ill-informed traders, because retail education, as we all know, is based on patterns like candlestick patterns, chart patterns, trend lines, support resistance zones, etc. And eventually they hope on to taking trades on the signals given by conventional indicators or price patterns. I'm not saying that these patterns and indicators don't work at all, but there are high chances that most of these can be engineered by the big players. These big institutions or smart money are always trying to trap us and take our stop losses. So when new traders come fresh onto the markets, they can easily be manipulated and money can be taken away from them because they are easy prey for the big boys. The retail traders' lack of knowledge as to where the majority of market orders are accumulated makes them vulnerable to these institutional traps. This is the major reason why most of the retailers lose money. They remain as prey to these banks and institutions, or in other words, they are liquidity for the big players. In essence, this is a cat and mouse game. In order for one person to win, someone else needs to take a loss. So the question is, what do you want to be, the cat or the mouse? Now there is a popular saying in the market that if you don't know where the liquidity is, then you are the liquidity. So in this episode and the upcoming episode, we will talk extensively about this prime concept of liquidity to stay ahead of the majority of retailers and also to stay clear of most of the smart money traps. I can guarantee you that once you understand the entire concept of liquidity, you will think more clearly as to how the market functions, and it will also open up new trading possibilities for you. So let's get started right away. For some of you, there might still be this doubt as to what exactly is meant by liquidity. So in simple terms, a market with high liquidity is one where there is a large number of buyers and sellers willing to trade in that particular asset. This means that there is a high availability of buy and sell orders, allowing transactions to be executed quickly and with minimal impact on prices. So think of liquidity as an area where there is stop losses and pending orders waiting to be filled. We can find liquidity in areas or zones where many people place their stop losses, be it buy or sell stops. Usually, retail traders are impulsive and they tend to buy at highs when greed kicks in and they sell at lows when panic kicks in. But at all times, when there is a buyer in the market, there is always a seller and vice versa. And that's how the markets work. Now, the smart money, aka institutions, use this retailer liquidity, that is the orders of the retail traders against them. For example, the institution buys at lows when retail traders sell after a breakout of that low. Similarly, they sell at highs when the retail traders buy after the breakout of a high. So in essence, we are all liquidity in the market. However, that does not mean every single order which is being placed in the market must be targeted and taken out by these big players, as some areas are simply not liquid enough for it to be worth the grab for these institutions. So in short, liquidity is like fuel, or it acts as a driver to move the market in a specific price zone. Smart money will try to manipulate the price in order to break through these obvious zones and seize or absorb the liquidity. To sum it all up, every market has retail traders and institutions. The retail mindset is almost same across all the markets. And liquidity in smart money concepts enable us to understand where these retail traders are being manipulated and where the smart money is entering or exiting. Now, another question can pop up in your mind. Where to find these liquidity zones or order clusters? Now, there are two types of liquidity based on direction. They are buy-side liquidity and sell-side liquidity. The buy-side liquidity represents a level on the chart where the short sellers will have their stop loss positioned. So essentially, these stop loss orders set by the short sellers who sold from the resistance or the swing highs are essentially buy orders. And the buy-side liquidity will also include buy limit orders set by all those buyers who were waiting for a breakout above the resistance or the swing high. When it comes to sell-side liquidity, it is just the opposite. It represents a level on the chart where long bias traders will place their stop losses. So essentially, this cluster of orders will include stop loss orders set by buyers who went long from the support level or swing low level, which in turn is a sell order. And sell-side liquidity will also include sell limit orders which were set by those sellers who were anticipating a breakdown below the support or swing low. In both these cases, these levels are often found at or near extremes as the tops and bottoms of the ranges, meaning that these points are found at the highs and lows of ranges. This is because at these points, many people are waiting for the zone to act as a support or resistance, or for the price to break the zone to continue in its direction. So you can always use higher time frames like daily, weekly and monthly time frames to identify these zones. Now, if you want to understand where to find liquidity even simply, then understand that whenever there is a trend line, support or resistance level, double top or double bottom patterns, channel patterns, rectangular ranges, swing levels, etc., there are a lot of retail stop losses and pending orders available, meaning that there is enough liquidity to be taken. Therefore, these are popular areas where retail traders tend to execute their trades. So there will be a lot of stop losses, making it a nice level of liquidity for the big players to target. But before all that, let us understand why liquidity is important on a price chart. So if you think about it, liquidity is extremely important because it is the direction in which the price moves. The price will always move towards these points to attract liquidity to the market. Without liquidity, financial markets cannot function. Let me explain this so that you will have a better idea. See, big players in the markets aim for the best prices, but usually they face challenges finding sufficient counter orders to fill their large orders. For example, if an institution is looking for long positions, they will place buy orders at limit prices. But for the order to get executed, there needs to be enough sell orders, right? Now think about what happens if they enter the market at low liquidity areas where there are only fewer orders available to counter the institutional orders. This will create much more volatile markets, which will negatively impact the average price of the big players, which is actually a risk they are not willing to take. Now, on the contrary, entering at a high liquidity area where there are a lot of counter orders available will result in less volatile markets, ensuring a better average price for the institutional position. And these high liquidity zones are where most of the retail orders are placed. Smart money players understand the nature of this concept, and they will commonly accumulate or distribute their large positions near levels where many stop losses resides. This concept of absorbing retail orders by taking advantage of all available liquidity at multiple price levels is called as liquidity grab or liquidity sweep, and it comes from the need for big players to enter the market in these zones to take their large positions, and it ensures that their orders are filled at the best possible prices by breaking up their order into smaller sub-orders and then spreading them across multiple price levels. So institutional traders and high-frequency trading firms commonly use liquidity sweeps for efficient and quick execution of large trade volumes. And the sheer amount of stop-loss orders available at these key levels allows a large player to fully realize their positions. And once this level where many stop losses have been placed has been traded through, it is often seen that the price will reverse its direction and head in the opposite direction, seeking liquidity at the opposite extreme. Now, think about the result when a large number of stop losses are triggered. If price experience higher volatility or more orders hitting the market, such volatility in price generates opportunities for participants to either enter a trade in a favorable environment or protect their positions. The fact that too many orders were triggered all at once result in sharp price moves in the market. So without ample liquidity to play with, we will never see such big directional moves in the market. In fact, how will a car be able to move without fuel? Similarly, it is liquidity zones and liquidity sweeps that helps to run the markets smoothly. Now, I hope this clears things up. Next up, let's briefly touch upon the different types of liquidity areas within the market structure. Based on this, liquidity can be classified into external liquidity and internal liquidity. Now, as the name suggests, liquidity associated with major market structure is referred to as the external liquidity. It is also known as major liquidity, and the liquidity associated with minor or internal structures in the market is named as internal liquidity or minor liquidity. In this video, however, I will only talk about external liquidity and how to spot external liquidity. So to understand what external liquidity is, we need to have a fair understanding about market structure, predominantly the major market structure. I have already made a video on market structures and how to properly mark the swing points, namely the swing highs and lows, and also to identify and mark break of structure, change of character, etc. So if you haven't watched the video, I urge you to pause this video right away and watch the first episode of this course right now to get a better understanding as to how major liquidity functions. To briefly summarize things, a bullish market structure will have higher swing highs and higher swing lows. A higher high is confirmed only after a valid pullback, and a higher swing low is confirmed only after a valid break of structure. And a change of character happens when the price break and close below the previous swing high or higher high, thereby shifting the market sentiment towards bearishness. Now, when it comes to a bearish market structure, it comprises of lower swing highs and lower swing lows. A lower high is only confirmed after a break of structure, and a lower low is confirmed only after a valid pullback. And a bullish change of character happens when price manages to break and close above the previous swing high or lower high, indicating a shift in the sentiment from bearish to bullish. Now, these are basically the things that you need to keep in mind while learning the major market structures. Now, let me ask you, which are the most important points when it comes to major structure? Quite clearly, these points are higher highs and lows and lower highs and lower lows, or simply these are the major swing highs and major swing lows. Now let me ask you another question. Why do you think the market does a break of structure or a change of character and then does a pullback? What do you think about this particular behavior of the market? Okay, let me explain. Let's take the case of a bullish break of structure and a bearish change of character. Now, what are they? These are basically simple breakouts, right? But if you think about it on a much deeper level, what exactly is taking place here? As we are aware, a bullish break of structure happens when price breaks and closes above the previous swing high or higher high. So one must focus on the swing high level. The swing high is considered as a strong resistance level or a supply zone. There can be at least two types of participants waiting in this area. The former would be sellers who are obviously trying to take short trades from the swing high or the so-called potential resistance level. And where will they put their stop losses? Quite obviously, they will set their stop losses, which is actually a buyback order above the swing high. Now, the second group involves buyers who are anticipating a breakout of prices above the swing high level because the current market trend is bullish. So, what will these buyers do? They will look to buy on the breakout and they will place their stop loss, which is a sell order, just somewhere below the swing high level. So as you can see, there is a large cluster of orders available above and below the swing high level. So this is a highly liquid area. So now what will happen? Depending on which side has majority of orders, the market will move in that direction to absorb or sweep the liquidity. In this case, a breakout above the swing high has happened, meaning that the concentration of buy order was much more than the amount of sell orders available below this level. This is why the market moved higher, absorbing all the seller stop losses and buy limit orders. A similar scenario takes place in case of a bearish change of character. Which is our level of interest in this case? Yes, you are right. It is the higher low or simply the swing low level. Now, applying the same logic here also, there are at least two interested players here. The former are buyers, since the swing low has the potential to act as a support or demand level, and since the trend is also bullish, the buyers will look to take long trades from this level. And where do you think they will set their stop losses? Quite obviously, they will set their stop losses, which mind you is actually a sell order, somewhere below the swing low level. Now, the second group comprises of those sellers who are looking for a breakout below this swing low level. Now, if you look carefully, you can see a proper trend line, and thus they will bet on the breakdown below the trend line as the price has tested the trend line multiple times. So they will look to sell on the breakdown, and they will obviously place their stop loss somewhere above the swing low or even above the recent swing high. So quite clearly, there are a large number of orders available above and below the swing low level. So this is a highly liquid area. Now what will happen? Depending on which side has majority of orders, the market will move in that particular direction to absorb or sweep the liquidity. In this case, a breakdown below the swing low has happened, meaning that the concentration of sell orders was much more than the amount of buy orders available above this level. This is why the market moved lower, absorbing all the buy stop losses and sell limit orders. I hope you have understood. In a similar manner, you can understand what happens during a bearish break of structure or a bullish change of character. Now, I hope things are making sense. But still, a question remains. Why don't the market just keep going in the direction of the breakout? Why do price stop and return back? Or why do prices form pullbacks? So, if you have observed closely, once the price does a break of structure or a change of character, it does not move up or move down indefinitely. If we take the case of a bullish break of structure above this previous swing high, we will come to know that the price will move up only to that extent where the orders are available. Or in other words, as long as liquidity is available above the swing high, the market will move higher. This is because the smart money is absorbing all the buy-side liquidity so as to sell high. And once it has absorbed all the orders above this swing high, where do you think the market will go? Now, one thing that you must keep in mind is that the market moves from one area of liquidity to the other. So based on this idea, where will the market find liquidity once it has swept all the orders above the previous swing high or once the buy-side liquidity is completely taken out? Think about it. There is no liquidity available anywhere higher. So no point in going higher. So where will the market go now? This is where we have to think about why the market does pullbacks after a break of structure or even a change of character. I can just tell you that it is the inherent nature of the market to move as waves, forming impulse and corrective moves, and just stop the discussion. But understanding the reason behind these pullbacks are very important. Let me remind you that the market needs fuel to move higher or lower. This fuel is none other than liquidity in the form of retailer buy or sell orders, as you may already know. Now, liquidity is the reason why market forms impulses and corrections. In this case, after sweeping out the buy limit orders and buy stops, which is actually the buy side liquidity, the market pullback slower. And what is the purpose of this pullback? The pullback is the way in which the market is looking for a sell side liquidity. And where can we find these clusters of sell limit orders and sell stops? This is why you need to have a proper understanding of how the market structure forms and functions. In this particular case, after a bullish break of structure, the market can pull back to a few possible levels where it could find liquidity. And only after it has tapped the liquidity from these levels, the market will continue to move higher. These levels could either be internal or minor swings formed within a wave, or it could be the major swing low also. Below these minor swings and major swing low levels, there will be a lot of players looking for a trade opportunity. Usually, the previous major swing low level is considered to be a strong demand zone or a support level. So most buyers would be interested to take a long trade from this level, and they will obviously set their stop losses below this major swing low level. So there will be a lot of sell orders available below this level, and so the market could tap into this liquidity pool to sweep all the retailer stop losses to buy at lower prices and then move up higher. Now the price won't always move all the way down to this major swing low. If you look at the chart, on most occasions, the price will pull back only by 40% or 50% before resuming the main trend. Now, what do you think is the main reason for this? Now, I want you to understand that when price pulls back, it has got a few liquidity options to tap into. I have not discussed some of these terms yet, but bear with me on this. So the first option is to tap into an inducement level, which you can consider as a previous minor swing below which you can find liquidity, as traders will look to buy from this level assuming a double top formation, while some sellers will place sell limit orders anticipating a breakdown of prices. Now both this action will result in a pool of sell side liquidity that the smart money can tap into. The next available options are order blocks or point of interest. And just for the sake of understanding, assume POI as areas where large number of buy or sell orders are placed by institutions for the sake of buying low and selling high, and we can expect the market to reverse from these zones. So the market can tap into either of the two order blocks. The first is a decisional POI, which is usually formed after an inducement, and there is a 50% chance that the market will tap into this liquidity area and reverse higher. And the other order block is formed near the major swing low level, and it is usually called the extreme POI. So the other 50% chance is that this extreme POI will be tapped to absorb orders. The price will go deeper into these levels to absorb all the available orders. Usually, we SMC traders will take buy and sell trades from any of these three mentioned liquidity levels. We will talk about the concepts of inducements, order blocks, POI, etc. in our upcoming episodes. But I hope you have understood the overall concept behind external liquidity. Now let us briefly take a look at where to spot these external liquidity levels, or under which circumstances can we observe these levels. So as you may have already guessed, the major swing highs and major swing lows, especially on higher time frames, are high probability areas where we can find major liquidity. You can understand this using a simple example. You can mark the structure on a 1 minute time frame, which is a lower time frame, and then mark the structure on a 1 hour higher time frame. In which time frame do you think there will be more orders present near the swing highs and lows? Without much thinking, we can say that the higher time frame swing levels will have more liquidity in comparison to the 1 minute swing levels, meaning that there will be more meaningful price reactions on higher time frame structures. Another location to find major liquidity is where equal highs or equal lows are formed near the previous swing highs or swing lows respectively on a higher time frame. There are good chances of finding sell side liquidity below these equal lows and buy side liquidity above these equal highs. The same logic applies to double tops and double bottoms, which are formed near these major swing points. Yet another location where you can find major liquidity is below an uptrend line drawn connecting the major swing lows, or above a downtrend line drawn connecting major swing lows. These trend lines are quite lucrative places because you can find both buy and sell side liquidity, because one party is looking to benefit from a breakout of the trend line while the other party is looking to gain from a reversal from the trend line. Obviously, the smart money will target these trend lines, and most often you can see fake outs from these trend lines, which are none other than the big players sweeping the liquidity to get better entry prices. Now, the other important locations where you can spot major liquidity includes the previous monthly highs and lows, previous yearly highs and lows, previous weekly highs and lows, and even the previous daily highs and lows. These are all levels that a large number of participants are keenly watching to take a trade, and therefore, there will be a large number of orders getting accumulated here. These are all prospective locations with very high liquidity. Since we don't have the kind of information that the big players possesses, we cannot determine the strength of a liquidity area and the exact location of liquidity at all times. Therefore, we can only predict where the liquidity can be discovered. But you must understand that the larger the time frame, the greater the liquidity. However, the more we go down onto smaller time frames, the more weak the liquidity will be. So these are all the things that you need to know about liquidity, especially external liquidity. In the next episode, we will turn our attention to internal liquidity. Are you one of those traders who gets into a trade near a level of importance, or be it a peculiar chart formation, but the price goes against your trade, takes out your stop loss, and the next thing you see, the price reverses its direction and moves in the same direction as you have anticipated in the beginning? I have been there, and it's very frustrating. And if you are one of them, then this video is for you. This video will definitely change the outlook of how you look at the charts. In the previous episode, we have talked in detail about liquidity, its importance, and we have also discussed in detail as to how major liquidity functions and where to find them. So, if you haven't watched that video, please make sure to watch it right away because it will give you all the basic stuff that you need to know when it comes to the concept of liquidity. But just to brush things up, liquidity is generally known as the fuel in the market, which is usually a cluster of retailer orders. That is, it can be limit orders and stop loss orders, which, when taken out or swept, causes the market to usually reverse in the direction of the existing market trend with a strong momentum. This will usually result in a fake breakout of the previous high or the previous low, which can be in the form of deep wicks taking out retailer orders. This is called as liquidity grab or liquidity sweep. Now, market always moves from one area of liquidity to another. So when liquidity is taken, the market needs to generate liquidity in order to move, which means if liquidity isn't already there, it will be created. And we have also talked about buy side and sell side liquidity. Then we have discussed about major or external liquidity, which in short is the liquidity available at or near the major market structure, which includes the major swing highs and major swing lows. You will get a good idea on market structures if you watch my video on the same topic on episode 1 of this course. In addition to this, major liquidity can also be found at or near higher time frame supports and resistances, weekly or daily highs and lows, etc. Now, in the previous episode on liquidity, I have classified liquidity based on market structure as internal and external liquidity. But looking at a much broader perspective, we can categorize liquidity into four types, of which the later two of them are actually applicable to the previous two classifications. I will explain this right now. But first of all, the different types of liquidity classifications are external liquidity, internal liquidity, static liquidity, and dynamic liquidity. As mentioned just now, external liquidity is the liquidity that can be identified above a range high or a range low, previous high or a previous low, or swing high or swing low. Internal liquidity, on the other hand, is the liquidity created within a range high and range low, previous high and previous low, or a swing high or a swing low. Now, when it comes to static liquidity, this liquidity is created or it is identified at or near double bottoms or double tops, or simply near equal highs or equal lows. And finally, dynamic liquidity is actually identified as the liquidity which is associated with a trend line. So, this liquidity is created at both sides of a trend, that is, above and below a trend line. Now, you might have understood how the last two types of liquidity, namely the static and dynamic liquidity, are related to the first two types. It is simply the fact that trendline liquidity and liquidity associated with equal highs or lows, or simply the double tops and double bottoms, are observable in both major and minor structures in the market. Now, we will understand about internal liquidity, how to read it or how to spot it, and how retail people get trapped in these areas. As you may know, minor liquidity is the liquidity associated with the internal market structures. This means all the clusters of retail orders which are getting accumulated between the major market levels, like the major swing highs or the major swing lows, are known as internal liquidity. So you can anticipate a lot of retail stop losses and limit orders at or near these minor swing structures. In the screen, you can see a few structures. These are all common areas where you can spot internal liquidity. We will first understand each one of them and then take a few examples from real charts. This is not a very difficult topic to understand. All you need to do is to think how a retail trader will respond when provided with a particular situation in charts. So all you have to do is to think like you always have as a retailer, and without much efforts you will be able to identify where the minor liquidity is already available. In the first diagram, we can easily spot equal lows. So technically, we have two lows on the same price level, thereby forming a minor support level. It is also known as double bottoms. We have learned that double bottoms are reversal patterns, right? So what do you think a retail trader will do when he or she spots a double bottom pattern? It is very obvious that they will try to take a long trade either after a breakout above the neckline, or some might even take a long position from the support level connecting the lows. Now comes the important question: where will they set their stop losses? Almost all of them will place their stop losses somewhere below the support level. Now you can imagine that there will be a large cluster of stop loss orders lying below this support level. These are all stop loss orders set by the buyers who have taken a long position, and these stop losses are sell orders or sell side liquidity. But what exactly do you think this is? This, my friend, is retail liquidity that we have been searching for. Now, what happens next? Or what will be the outcome? The smart money will always look to buy at lower prices, and they will look to sell at higher valuations. They do not follow any strategy or patterns, but they take their positions based on liquidity. So, most often or not, they will look to tap into these areas of liquidity to execute their positions at the best possible valuations. Now, coming back to a discussion on double bottoms, the smart money or institutions will push the prices down and break below the equal lows or support level so as to absorb all the sell side liquidity. And once all the stop losses are absorbed or swept, the market usually reverses its direction and move higher. This is usually more frustrating for traders than hitting the stop losses, because usually such a move will impact a trader's psychology, and it will also question his analysis and learnings. So, in short, there is liquidity below equal lows or below the support level connecting the lows of the double bottom, which is actually a cluster of sell stop loss orders or sell side liquidity which gets tapped by the big institutions to buy at lower valuations. Now, the second diagram shows equal highs. It means that we have two high points on the same price level. This is also known as a double top pattern. Like a double bottom, this is also a common reversal pattern that you can find on charts. If you have clearly understood how liquidity and retailer mindsets works in case of a double bottom, then understanding the logic behind double tops or equal highs is just a piece of cake. Ask yourselves, what will a retailer do when they spot a double top pattern? They will try to take a short trade either after a breakdown below the neckline, or they might even sell when the price starts falling from the top resistance level connecting both the tops. Now, where will they set their stop losses? Most commonly, retailers will place their stop losses somewhere above the top resistance level. Now you can imagine that there will be a large cluster of stop losses lying above this resistance, and almost all these stop losses are placed by short sellers who sold from the resistance or neckline. So technically, this cluster of stop losses are buyback orders or buy side liquidity, and this is the liquidity that smart money is keen to tap into. So, what do you think will happen next? Smart money will always look to sell at higher valuations, and they will try to collect the retailer buy stop loss orders or the buy side liquidity which is clustered above the double top or the top resistance level. So, most often they will push the prices higher and break above the equal highs or resistance so as to absorb all the retail orders to sell their positions at the best possible prices. And once all the stop losses are grabbed or swept, the market will usually reverse its direction and move lower, which can be really heartbreaking. Now, if you have understood both these types of liquidity, then the next few types are going to be really easy. Yes, we are talking about support and resistance liquidity next. So, what happens in a support level? Think about it in terms of a retailer. What will be a retail participant's thought process? So, when price test a support level few times, we can anticipate two types of market participants around this area. The first group involves buyers who are looking to take a long position at or above the support level to take a reversal trade. The second group are sellers who are looking to profit from a breakdown below the support level. Now, how will both of these players act in this scenario? First up are the buyers. They are looking to take a long trade entry, so they will try to buy at or above the support level and they will place either buy limit orders or market orders. Now comes the important question: where will they place their stop loss? They will set their stop loss somewhere below this support level, which is actually a sell order. And when it comes to short sellers, they are looking for a breakdown below the support level. So they will either place a sell limit order or a sell market order at or below the support level when the breakout happens. And these guys will set their stop loss somewhere above the support level, which is actually a buyback order. Now, as you can visualize, there are a large clusters of buy and sell orders getting accumulated above and below the support level. Or in other words, there is sell side liquidity or clusters of sell orders below the support and buy side liquidity or clusters of buy orders above the support level. And this is a golden opportunity for the smart traders to capitalize on. So, what do you think will their action plan be? You might have seen and experienced this happening many times in the chart. The smart money will first push the price below the support level to break into the sell side liquidity so as to be able to execute their large buy order positions at the lowest price possible. This will result in retailer sell orders and sell stop losses being triggered. Now the buyer positions will automatically be exited when their stop losses gets hit, while the sellers are still in their trade and their buy stop losses are still active above the support level. Now once all the smart money orders are executed by the retail sell orders which was accumulated below the support, they will push the price higher. And what will happen now? Now all the buy stop orders which were set by the sellers will get triggered and they will also be out from their trades. This will lead to the market moving higher strongly. This will in turn induce the FOMO traders to start buying and thereby pushing the markets even higher. This is a typical case of false breakout and liquidity grab in the market. And even now, a majority of retail traders are unaware of this smart money trap. The same action plan happens in the case of resistance levels also. Here also there are two players. There are sellers who look to take advantage of a reversal from the resistance level so as to initiate a short position at or below the resistance. They will set their stop losses somewhere above the resistance level. Then there are buyers who are looking to benefit from a breakout above the resistance so as to buy above the resistance. These guys will set their stop losses below the resistance in the event of a breakout. So there is buy side liquidity above the resistance and sell side liquidity below it. And as you might have guessed, the smart money will try to manipulate both these players. They will first push the price above the resistance so as to execute their sell orders at higher valuations by absorbing the buy orders or buy stop loss orders, thereby taking out the short sellers out of their trades. But the breakout buyers are still active in their trades and their stop loss orders are still live below the resistance level. Or, in other words, the sell side liquidity is still available below the resistance. And once all the large smart money positions are filled, they will push the prices lower, thereby absorbing the sell side liquidity and taking out the breakout buyers. This will cause the price to fall rapidly, which will encourage the FOMO participants to start selling and thereby causing the market to decline even lower. This is another typical case of false breakout associated with a liquidity grab. A similar approach is seen during consolidations, especially the rectangular ranges. When it comes to rectangle patterns, we have a bottom support level and a top resistance level. So, most often, the false breakout happens in the opposite direction of the market trend. For instance, if the market structure is bullish, then most probably we might see price absorbing the retail liquidity available below the bottom support level and then push higher to form a real breakout above the resistance level. On the contrary, if the market structure is bearish, then most probably we might see a false breakout above the top resistance level so as to absorb all the buy side liquidity, and then the price might move lower and form a real breakdown below the support level. Now, this analysis is not 100% accurate because we cannot predict the occurrence of a false breakout perfectly. Since there is liquidity available on both sides of support and resistance, it can lead to more than one fake outs. Or in some cases, there might not even be a fake out. Now, let's talk about the next category of internal liquidity, which is the trend line liquidity. Now, trendline liquidity is one of the most common types of smart money manipulations that you can encounter on charts, especially when there is a predominant trend involved. Technically, there are two types of trend lines: uptrend lines and downtrend lines. Another important thing to keep in mind is that for a line to be considered as a trend line, there should be at least two touches on it. And to confirm a valid trend line, there needs to be at least three touches on it. Now, this concept is easy to understand if we compare it to support and resistance. So, consider the uptrend line as a support level for prices and downtrend line as a resistance level for prices. Now, it is easier to visualize the events better. So, let's start with an uptrend line. As I have mentioned, an uptrend line acts as a support for prices. So we can expect two types of participants waiting to take a position. There are buyers looking to go long from the support trend line. Then there are those short sellers searching for a breakdown below the support trend line. Thus, there lies buy side liquidity above the uptrend line and sell side liquidity below the trend line. This means most often both retail buyers and sellers stand to lose their stop losses. The big institutions will first push the prices down to break below the uptrend line. This means all the sell stop orders of buyers and sell limit orders of short sellers will be triggered. The smart money will try to absorb all the retail liquidity to ensure that their large buy positions are executed at the lowest prices possible. Now, only the short sellers are active in their positions with their buy stop losses live above the trend line. Once all the smart money orders are filled, they will take the prices higher, revisiting the buyback orders placed above the support trend line. By doing so, the short sellers will also be taken out of their positions once their stop losses are triggered. This will in turn push the prices higher. So you can see how both retail sellers and buyers are equally affected by such a manipulation. A similar scenario persists when it comes to downtrend lines also. There will be buy side liquidity above the resistance trend line and sell side liquidity below it. The smart money will create a false breakout above the trend line, sweeping all the buy side liquidity in order to execute their sell positions at the best possible valuation. And once all their orders are filled, they will reverse the prices to move lower, which then takes out the sell side liquidity, and then combine it with the new FOMO sellers coming in, the market will fall even more. Finally, there are people who look to trade prominent chart patterns like flag patterns, which unfortunately is yet another internal structure formation that is prone to liquidity manipulations. You might know about flag patterns, how it forms, and how to trade them. If you don't, you can watch it in my chart patterns course video. Basically, there are two types of flags: bullish flags and bearish flags. Let's start with the bullish flags first. Flags are continuation patterns, meaning that the possibility of the existing trend to continue is fairly high. When a bullish flag consolidation is spotted, the retail traders will look for a bullish breakout above the top resistance line. Now, majority of this group includes buyers who are looking to take a breakout trade, and they will usually set their stop losses below the bottom support level. This is the usual practice. Now, the manipulation happening here is very exciting. First, the smart money will create a small reaction above the top resistance level of the flag. This minor reaction above the resistance will induce a lot of former retailers to take the bait. That is, they will think it is a breakout. And these traders would rush in and place their buy market orders and buy limit orders above the resistance in order to buy, and they will in turn set their stop losses below the bottom support level. But most probably, this reaction would be a false breakout to trap the retailers into taking a trade. Now, the price would move lower and break below the bottom support level, where lies a large clusters of sell side liquidity, and these institutions will ensure that all their buy orders are executed at the lowest prices possible. Sweeping the sell side liquidity means that all the buy stop losses are triggered and they are taken out of their trades. Now, what happens afterwards? Quite clearly, the market will bounce back higher and this time creating a real breakout instead of a minor reaction. And once a strong breakout with high volume appears, more traders would join in and the prices would rise even higher. A similar scenario takes place in case of a bear flag. But here, instead of buyers, the FOMO sellers would get trapped. A bear flag, as you may already know, is a bearish continuation pattern. So most of the retailers would look for a breakdown of prices below the bottom support line so as to take a short trade position while setting the stop losses above the top resistance line. So the smart money will create a sudden price reaction below the support line, which will induce a lot of retailers to enter into short trades. This activity causes a lot of buy stop orders getting accumulated above the resistance line. This is actually buy side liquidity. And the market will create a false breakout and it will move higher to grab this liquidity in order for the smart money to execute their sell orders at higher prices. Now, almost all the buy stop loss orders above the resistance level will be triggered, and those traders will be taken out of their positions. And once all the smart money orders are executed, the market will once again reverse and move lower. And this time, the market will form a real breakdown below the flag support, to which more short sellers would respond by selling aggressively, and the market will fall even lower. Now, there are other patterns and other situations in the market where internal liquidity is available for the taking within the major structure. Some of them are symmetrical triangles, price channels, supply and demand zones, etc. But the ones that I have discussed here are the most important types, and it is more than enough to get a fair understanding as to where to find internal liquidity and how to find smart money traps associated with them. Now let's move on to a few quick examples of such internal liquidity manipulations in the real market conditions. Take a look at this chart. You can see price making equal lows. So clearly there is sell side liquidity below this level. And what happens next? As you can see, the market moves down and absorbs these clusters of orders and then it reverses to go higher. Usually, when liquidity is absorbed, the price will move quite strongly. Moving on to example 2, what we have here is equal highs. And you know what that means. It means there is buy side liquidity available above this level. Now, the smart money are eager to manipulate or absorb these liquidity areas. And guess what happens? The price breaks into this liquidity area and sweeps out all the retailer orders above it. And then it moves down lower. This is a typical manipulation that you can find on charts on a regular basis. You can call it double tops or double bottoms also, but the logic remains the same. Now, example 3 is a support level within the major structure, and we have talked about how the manipulations takes place around a support level or a demand zone quite clearly. So there is buy side liquidity above it and sell side liquidity below it. And look what happens next. The market breaks below the support level, gets hold of the retailer stop losses, and then reverses and goes higher, taking out the buy side liquidity. This price manipulations affects both the players. Now, this is example number 4, which is a resistance level within the external structure. Here also, you can anticipate retailer orders stacking above and below the resistance. So there is buy side liquidity above the level and sell side liquidity below it. And as you can see, the price broke above the resistance level to sweep the buy side liquidity. And once it is done, the market reversed its direction. And in the process, it takes out the sell side liquidity and moved lower. Now look at this case. An internal uptrend line has formed within the major structure. From what we have learned, there are both types of orders available above and below this trend line. And look what happened here. The price broke below the trend line, thereby taking out the sell side liquidity, and then it did a sharp reversal and moved higher. Now, yet another example is of a downtrend line which formed within the major structure. Here, the price made a false move higher to grab the retailer liquidity and then reverse lower to continue in the major trend direction. The next example is one of a flag formation. This is a bullish flag formation. And as you can see, the price made a false breakout or reaction below the support level just to absorb the liquidity available in the form of stop losses
and then the price broke above the flag and moved higher. This is a similar example, but this is a bear flag formation. Here you can see the market took out the liquidity above the top resistance line, and then the price returned and broke below the lower support and continued to decline. In this manner, using this simple logic, you can spot innumerable liquidity manipulations in the charts. It could even be in the form of recognizable patterns that most retailers are keen to trade from. So go ahead and look for such manipulations and liquidity grabs in the charts, and also try to understand what happens next. You will clearly understand how the price movements are engineered in the markets once we have a discussion on a few more topics like order flow, order blocks, and inducements. We will continue this discussion in the upcoming episodes.
In this episode, we are going to learn another important topic in SMC, without the knowledge of which trading in the markets can be tricky as well as risky. It is none other than inducements. Some traders ignore the significance of this topic, while many others don't use it in the proper manner. We will try to fix this. So in this video, we will understand what inducement is and what its significance is. Then we will learn different methods of identifying and spotting inducements in the market. Further, we will discuss about the different types of inducements, namely major and minor inducements. And finally, we will understand the difference between inducements and change of character. So watch the video till the end to gain complete understanding of the entire topics. So let's get started. Now there are different ways in which you can define an inducement, but I would like to think of inducements as an area or level where retail stop losses can be hunted, or simply think of it like a trap in the charts. The proper definition of inducement is that inducement is an area of deception where most traders believe it is the correct and right time to enter a trade, leading them to take wrong decisions at the wrong locations and in the wrong direction. So the idea of an inducement level is to induce or persuade traders to buy or sell at the wrong location, thereby leading them to a trap. Now, inducement is a concept based on liquidity. For example, think of it like a level where retailers find an opportunity to take a trade. But for someone who follows smart money concepts, inducements give them an opportunity to take a counter trade against these retailers. Or in other words, inducements signal SMC traders that it is now feasible to take a trade. It is always advised that until and unless there is a proper inducement in the chart, one should not even think about entering into a trade position. This is because the chances of it being a trap otherwise is very high and you might end up in losses. So the reason why this is particularly important is because of the fact that inducement follows the nature of liquidity. So if you have noticed, liquidity follows an accumulation, manipulation, distribution cycle, also known as the power of three. Let me explain this. Accumulation represents a stage within the market cycle where prices tend to consolidate while engineering liquidity on either side. The manipulation phase follows the accumulation and is often marked by sudden and sharp price movements that catch retailers off guard. Manipulation occurs in the opposite direction of the real move, and it is aimed to stop out the retailers and induce the breakout traders. So understanding the intentions behind manipulation phase is very crucial. Smart money uses these moves to acquire more shares or assets at favorable prices. By triggering stop losses and inducing breakout players, they generate enough liquidity for their positions. They accumulate positions while retail traders are caught on the wrong side of the trade. Now comes the distribution phase. After accumulating at the best possible valuations and manipulating the market to their advantage, smart money begins to unload their positions to those eager retail traders who are late to the game. The distribution phase in SMC is quite a bit different from the distribution phase that we have learned in the price action course. Here, during distribution, the smart money slowly offloads their holdings, typically in a controlled manner. They distribute their shares to the retail traders who are jumping in, eager to open new positions at higher valuations. This influx can sustain the rally for a while. This AMD concept emphasizes that recognizing these phases is essential for successful trading. By understanding when smart money accumulates, manipulates, and distributes, traders can align themselves with the dominant forces rather than getting caught on the wrong side of things. So this is the whole concept behind inducements also. There are other significance of inducements which we will talk about in a short while. Now, how exactly can we find inducements in the charts? What are the things that we need to consider? So there are two methods which you can apply to find inducements, both of which has certain limitations of its own. These are the first pullback method and the trend line method. Let's talk about the first pullback method. This is actually the first pullback after a break of structure. The idea is quite simple. An inducement is considered as the first pullback after a valid break of structure has happened. These pullbacks are minor pullbacks or internal pullbacks which can be formed using a single candle, a group of candles, or even a deep wick. You can see the different types of pullbacks that you can find on charts here. Even though we consider inducements as the first pullback after a valid break of structure, in certain scenarios, we might need to tweak this rule by a little bit. Let us understand this using a few examples. We will first consider some bullish market scenarios on a major market structure. Before that, make sure you have a fair understanding about the market structure mapping. You can watch that video in my SMC playlist. Anyways, here we have 4 situations. We will take a detailed look at each one of them. In the first case, we can see the price break and close above the previous major swing high. This is our valid break of structure. Now let us see what happened after the break of structure. You can notice how the price moved higher and then it formed a minor pullback. As per our definition, the low of this minor pullback is our inducement level. We can draw a small horizontal line at this low to mark the inducement. For easy identification of this line in the future, we can name this line as IDM, or you can even use a dollar sign for the same purpose. Now you can see what happened next. The price moved lower and break below this inducement line. This means that the liquidity below the inducement level has been absorbed or the uninformed retail traders are trapped. Only when the inducement level is taken out should we start thinking about a trade. Mostly, the market will move in the direction of the existing market trend after taking out the inducement. But this does not have to happen immediately. The price can reverse after sweeping a liquidity area, or it can reverse from an order block also. So inducement is a useful concept before taking a continuation trade. But as always, this cannot be said with 100% accuracy. There can be such instances where the market could just fall lower and break below the major swing low and thereby forming a change of character instead. Now moving on to the second example, in this case, we can observe that the price moved higher and it break above the previous swing high level. But the price did not manage to close above the previous higher high, so this is not a valid break of structure. Therefore, we cannot spot the inducement yet. And what happened afterwards? The price did manage to break and close above the previous major swing high level. So now we have a valid break of structure. Now the price moved even higher and formed a minor pullback. Now we can mark the low of this pullback using a line. This is our inducement level, which is denoted by IDM or a dollar sign. But as you can see, the price did return back to take out the liquidity below this inducement level. Keep in mind that only after the inducement is taken out should we think about taking trades from an order block or from an area of liquidity. Inducement is also used as an order block filter. The idea is that inducement levels are considered as smart money traps because it induces retail traders to take a short trade from an inducement level which is above the price of interest or demand zone during a bullish market structure, thereby making them to trade in the wrong location as well as in the wrong direction. For those who are unaware of what price of interest is, POI or price of interest is a price level or a price zone where there is a very good probability that the market could react with it and respond accordingly. A POI is also called DP or decision point by some experts. So a POI can be any of the following. It could be an order flow, an order block, a supply or demand zone, session highs or lows, daily or weekly or yearly highs and lows, or it could even be price caps. In a similar manner, inducement persuades retail traders to enter into a long trade position from an inducement level, which is below a price of interest or a supply zone during a bearish market structure, thereby making them to trade in the wrong location and in the wrong direction. So most often or not, price will break this inducement level and take out the retailer liquidity. So this is a very common smart money trap. And this is why it is always recommended to take trades once the liquidity associated with an inducement level is taken out. Because once the price has swept the liquidity associated with an inducement level, there are good chances that the price can reverse without testing any price of interest or supply or demand zones. I hope things are making sense. Now look at this third example. Where is the inducement in this case? It is clear that the price did form a valid break of structure, but as per our definition of inducement, the price did not create any minor pullbacks after the bullish break of structure. But the price did form a pullback just before the break of structure. So in such instances where there is no pullback formed after the break of structure, we will consider the last minor pullback before the break of structure as the inducement level, and we can mark it using a line and name it. Now look what happened next. The price did return all the way down and took out the liquidity below the inducement level, and then it moved higher. So this is a special case where we have to make adjustments and not blindly follow the textbook definition of inducements. Now take a good look at this last example. Here the price gave a clean breakout above the previous higher high. So it is a valid bullish break of structure. Then the price moves higher and forms a minor pullback. So as per our rule, we will draw a line at the low of this pullback and mark it as our inducement. Now did the price return to grab the liquidity? No. The price did not come back. Instead, the market moved higher and then it formed another minor pullback. Now, what will we do? If such a case takes place, we should shift one inducement level forward to the low of this newly formed pullback. And even if the price don't take out this new inducement level and it moves higher and then create another pullback, then without any doubt, we should shift our inducement line to this new low formed. This is yet another important concept in connection with the basic rule of first pullback. And as you can see, the price returned to sweep the liquidity below the inducement level, and then the market continued higher after absorbing all the liquidity. The idea remains same for bearish instances also. Let's quickly look at a few examples for bearish market structure. In the first example, price formed a valid break of structure. Then it moved lower and made a minor pullback. So as per the rule, we can draw a line at the high of the pullback and mark it as the inducement level. The price did come back and sweep the liquidity above this line. Moving on to the second example, here the market did not give a valid break of structure at first. Then price consolidated a bit and then finally it break and close below the previous swing low level, thereby forming a valid bearish break of structure. And then once it moved lower, it formed a minor pullback. We can mark the high of this pullback as our inducement. Then we can see that the price returned to take out the liquidity above the inducement level. So an important point to be noted here is that you should never look for an inducement until there is a valid break of structure. Now in this third example, the price created a valid bearish break of structure, but the price did not form any minor pullback on the way down. Instead, it formed a corrective move towards the upside. In such cases, we can mark the high of the last pullback before the break of structure as our valid inducement level. In this scenario, you can see how the price moved higher and took out the liquidity above our inducement level and then fell lower. In the last example, the market formed a minor pullback after a valid break of structure. Then we can mark the high of this pullback as our inducement level. But the price declined even lower without grabbing the liquidity. Then it formed another minor pullback on the way down. In this case, we can shift our inducement line to the high of this newly formed pullback. And we can notice what has happened afterwards. The price swept the retailer liquidity above this inducement level. Now, let me remind you again that you should never think about taking a trade until and unless the inducement level is not taken out. This is mandatory if you are following smart money concepts. Now, always keep in mind that inducements should be marked on the impulse move that caused the break of structure. It should not be marked on the corrective move like in this case. This is the wrong approach. The only exception is when the market forms a valid change of character, in which case the correction move gets converted into the impulse move of the counter trend. Take a look at this scenario. Here, the price break and close below the previous higher low level, thereby confirming a bearish change of character. In this instance, we have to look for inducements in the price move that has caused the change of character. In that sense, we have to mark the inducement at the high of the first minor pullback after the valid bearish change of character. So make sure you are marking your inducements in the right manner.
Another importance of inducement is that it helps to identify and confirm the higher highs in a bullish market structure, and it helps to confirm the lower swing lows in case of a downward market structure. In the market structure mapping episode, I have mentioned that you need a deep pullback after a valid break of structure to confirm your higher highs in case of a bullish trend, and also to confirm your lower swing lows in case of a bearish structure. I asked you to use Fibonacci retracements to identify deep pullbacks, but this is a time-consuming process. So a rather simple hack is just to identify the valid inducement level. Then the highest point above this inducement line, once its liquidity is taken out, will be our higher high in case of a bullish market structure. Similarly, the lowest point below the inducement level, once the liquidity above the inducement is grabbed, will be our lower swing low in case of a bearish market structure. Now let's talk about the second method of identifying and marking inducements, which is by using trend lines. The idea is very simple. Let us consider a bullish market scenario. Keep in mind, whatever happens, we will look for inducements only after a valid break of structure. Here you can see how the price break and close above the previous higher high, thereby forming a valid bullish break of structure. Then the market moved higher. What we will do is that we will draw a trend line connecting all the minor lows within the major swing. Or in other words, we will try to connect all the internal swing lows using a trend line, as you can see in this figure. Then we will wait for the price to break and close below the trend line, which will in turn induce retail traders to sell because of a trend line breakdown. All these retailers will be trapped and their orders will be taken out. Now, in a bearish market structure, we should look for a valid bearish break of structure below the previous swing low level. And when the price falls lower, we can mark all internal highs formed after the recent swing high and then connect all these minor highs as and when they are formed. And when the price breaks and closes above this downward trend line, we can expect retail traders to take buy positions as they have spotted a trend line breakout. This is our inducement. All these retail traders will be trapped and their orders will be absorbed. Now there are a few problems with this trend line method. First of all, trend lines are subjected to human errors. This means different traders would draw and interpret trend lines differently. So the inducement identification varies vastly from person to person. So this confusion is not a good thing. The second issue is that sometimes even after a breakout below the trend line, the price would not move below the inducement low, which means the liquidity below this level is not absorbed. This could lead to wrong analysis. Because as per our pullback method, the inducement level gets shifted to newly formed pullback lows as long as the liquidity is not swept by the market. So from my experience, it is better if you stick with the first pullback method after a valid break of structure for marking your inducements. Now let us talk about major and minor inducements. You might have already guessed what these are. Anyways, the differentiating factor between the major and minor inducements are the time frames. It will also depend on your trading style. So if you are an intraday trader, then your higher time frame can be 15 minutes, while your lower time frame can be between 1 minute to 5 minutes. So if you were to map your market structure and mark your inducements on a 15-minute higher time frame, then you are indeed marking the major inducements. Now, if you start mapping the structure and mark all the inducements on a 5-minute lower time frame, and then consider all the internal price swings and the associated break of structures, then you're drawing the minor inducements. On a similar note, if you are a swing trader, then your high time frame can be 1 day or 4 hours, whatever it may be, and your low time frame could be 1 hour. In this scenario, your major inducement is marked on your higher time frame major or external structure, while your minor inducement is marked on your lower time frame structure, which is 1 hour, and considering all the internal price moves within the major swing structure. Now, the idea of identifying and marking minor inducements are also the same as with major inducements. But because we are making use of lower time frames and also taking into consideration the minor or internal structure, we will be faced with a lot of minor structure breaks. This will result in a lot of inducements getting formed. These minor inducements can be helpful for those traders who wants to collect some quick profits while waiting for the price to take out the major inducement level. But there is a small change in concept when it comes to minor inducements and change of character in a lower time frame internal market structure. So let's clear that out. So this is a bullish market structure on a higher time frame, and to the right is how the lower time frame structure looks like. And as you can clearly see, in the lower time frame, the internal price swings are quite detailed and visible. Now let us mark the break-off structures in the minor time frame. Once the break-off structures are identified, let us find the proper inducements. We will try to mark the inducements as per the first pullback after the break-off structure rule. Now since we have marked the bullish break-off structure, we will have to spot the lows of the first pullback. Here I have marked all the lows of the pullback, and we can draw a line at these lows. These are our inducements. Now you can see how the price reacted in these inducement levels. Now let us focus our attention on this last inducement level before the market reversed lower. So before it reversed, the price tested a supply zone or a price of interest. So this is not really an inducement, but instead this is a change of character or chalk in the minor structure. So the simple difference between an inducement and a chalk in a minor structure on a lower time frame is that inducement is the first pullback after a valid break of structure, but a chalk becomes that inducement level before the market tests a price of interest. Let us look at a bearish case also to help us understand the idea even better. So first, you need to go to your higher time frame and map the structure. That is, you need to find your lower highs, lower lows, break-off structures, and change of characters if any. Then, you need to mark the major inducements in this higher time frame structure. So if you are an intraday trader, map your structure on the 15 minutes higher time frame. The next step is to move to your lower time frame, which can be between 1 minute and 5 minutes. Let's take 3 minutes for our purpose. In the 3 minutes chart, you will get more granular details on the internal structure and a lot more of swings. Now start identifying the valid minor break-off structures when the price break and close below the previous internal lows. Then start identifying the minor inducements, which are actually the highs of the first pullback after a valid minor break-off structure. Now this last inducement before the price reversed after testing a price of interest or a demand zone will be our change of character. So in the market, change of character can happen on two occasions. First of all, as you may already know, a chalk happens on a major market structure when the price breaks and closes below the previous major swing low in case of a bullish market, resulting in a bearish change of character, or we can say there is a change of sentiment from bullish to bearish. It can also occur when price break and close above a previous major lower swing high level, resulting in a bullish change of character. The second scenario where a change of character can be identified is on a lower time frame internal structure where your inducement becomes a change of character when it tests a price of interest and reverses. I hope things are clear. So these are all the important things that you need to know about inducements as an SMC trader. Inducement is one of the most vital liquidity concept in the whole of SMC course. So make sure you learn the concept properly, practice it on different charts, backtest it to find out if it actually works for you, and take trades to get comfortable using it. In this video, we are going to learn two important topics in SMC. They are order flow and order blocks. These are related topics, so it makes sense to make a single comprehensive video on these topics so that we can learn how they are different from one another. Now let me warn you, this is going to be the longest video in this entire course. So watch it when you have adequate time because this is one of the most demanded smart money videos. In the previous episodes, we have discussed the concepts of liquidity in great detail, which is actually the core of SMC learning. And if you haven't watched these episodes, I strongly urge you to watch them right away. Now, a fair understanding on liquidity will give you a lot of insights into the ways which smart money institutions operate. But that is not enough to convert into profitable trade setups. For getting the best possible trades, you need to have a fair idea as to where to take the entries. This is where order flow and order block come into the equation. These are simple yet effective methods by which you can spot potential areas from which you can hop into a trade position with minimal risk and high chances of profits. So in this episode, we are going to start our discussion with order flow, how to identify an order flow in charts, what are the different types of order flows and how do they work. Then we will discuss about order blocks. Why is it important to have an order block? How to spot an order block?
the different types of order blocks, and what are all the key points that you need to keep in mind. And we will also learn how to identify a valid order block. We will not talk about order block refinement in this video. We will cover it in a separate video. So watch this video till the end so that you will not miss any important aspect. And if you appreciate our work in creating valuable content free of cost, make sure to like and share this video. And if you are new to this channel or you haven't already subscribed, do make sure to subscribe and also enable the bell notification so that you will never miss any upcoming update. So without wasting any time, let's get started. We will begin with the order flow. I have told you in the liquidity videos that market moves from one area of liquidity to the other. This can either be internal or minor liquidity or external or major liquidity. The market can tap into either of these liquidity areas or zones and then reverse the price direction after sweeping the retailer orders. In the charts, a lot of such liquidity areas are generated, and it is obvious that not all of them are worth considering, and only a few of them will provide us with high quality trade setups. So how are we going to capitalize on our knowledge in order to make highly probable and profitable trades while reducing the risk of overtrading or simply getting into trades at all these liquidity areas? This is where order flow and order blocks come into the picture. So think of an order flow as that price move in the chart which to most extent reveals where the smart money hides their positions or where they are most likely to initiate their positions. If you have observed the flow of prices in the market structure, you will notice that the price will not always tap into the external structure before reversing its direction. The market might reverse even before that. This is due to the existence of order flows. Technically, there are two types of order flows. These are bullish order flow formed during an upward market structure and a bearish order flow which is formed during a bearish market structure. I have said this many times, but I will say it again, that you need to have a good understanding as to how to mark the market structure properly in order to make the best use of these concepts. If you get your market structure mapping wrong, everything else will meet the same fate. So make sure to watch the first episode if you haven't already. Now coming back to our discussion, let us consider a bullish market structure and try to spot the order flow. During a bullish market, the major price structure forms higher highs and higher lows. But if you observe the corrective moves, you will notice that it forms lower highs and lower lows. So a bullish order flow is represented by the last selling price before the bullish price momentum. Or in simple terms, the last selling move before the buy is called as the bullish order flow. Therefore, all you have to do is to identify the bearish candles before the price begins to move higher. This is how we spot bullish order flows in the charts. Let us now learn how to spot a bearish order flow. You will find bearish order flow in a bearish market structure. In a bear market, the major structure forms lower highs and lower lows, while the corrective moves forms higher highs and higher lows. And the bearish order flow is represented by the last buying price move before the ongoing bearish price momentum. Or in other words, the last buying move before the drop or sell is called as a bearish order flow. Therefore, you need to identify the bullish candles before the price begins to drop lower. But is the order flow that we have identified a valid one? This is a question which is very important to consider. Order flows can be classified into three types. These are mitigated order flows, unmitigated order flows, and failed order flows. Out of these three, only the unmitigated order flows are of any use to us. But for the sake of understanding, I will explain all of them. Basically, a mitigated order flow is one where the price has already tested or mitigated the order flow. Think of an order flow or even an order block as a one-time use thing. Once it is tested or mitigated, it is of no use to us anymore. It is not like our typical supports or resistances where the price will respect it multiple times. But this is not the case with order flows and order blocks. Check out this example. We have identified the last selling move before the buy. So technically, this area is an order flow. But if you notice closely, you will see that the price has tapped into the bullish order flow. Therefore, this bullish order flow is mitigated by prices. This means that the order flow will not work in the future. Look at another example, but this is for a bearish structure. We can spot the last buying move before the drop and mark this area as a bearish order flow. Then you will notice that the price has tapped into this order flow and therefore it is already mitigated.
So this order flow will not work for the future price moves and it is not worth considering. The second type is unmitigated order flow. In this case, the price will not tap into the order flow or the price will not mitigate the order flow. These are the order flows which are useful to us. This is because there is a high probability that the price might return back to mitigate this order flow. Now we can take a few examples to understand this better. In this first case, the market is in a bullish trend. So during the corrective move, the price forms lower lows and lower highs. Our order flow will be the last selling move before the buy. Once we have marked the order flow, we can observe that the price has not tested or mitigated this bullish order flow. It also means that the price could come back to this order flow later to mitigate it. So this is an unmitigated order flow. Similarly, if we spot a bearish order flow in a bearish market structure and the order flow is not tested or mitigated by prices, then this is an unmitigated order flow zone, which could be a potential area of interest for a price reversal in the future. Now keep in mind that even the wicks projecting into an order flow zone mitigates it. So the tiniest of tiny details matter. Now what is a failed order flow? So it is an order flow which we have identified and marked through which the prices passes through. Just like a mitigated order flow, failed order flows are of no use to a trader. Another point to keep in mind is that once an order flow is mitigated, you can always shift towards the next one, and if the next one is also tested, then you can shift towards the next order flow and so on. Now, let us briefly look at how to take trades using the order flow concept. The idea is to take a trade from the order flow zone when price comes back to test the order flow during a pullback, which follows the break of structure, and then take a trade entry when the price begins to reverse from the order flow after mitigation. As I have mentioned a few times, this should only be applied to unmitigated order flows. If you know how to correctly mark the market structure and identify the pullbacks, then this is going to be very easy. Now let us consider an example for bullish and bearish scenarios. This is a bullish market structure. Here you can see that the price has created a bullish break of structure when it broke above the previous major swing high. We can identify the unmitigated order flow by using the method that we have learned. Now we have to wait for a valid pullback to happen. And as you can see, the pullback returned to our unmitigated order flow and tested it. By now, we can anticipate two outcomes to happen. Either the price can break below our order flow, forming a failed order flow resulting in no trades, or the price can test the order flow and reverse its direction to move along with the major bullish structure. If it were the second scenario, we can take a long trade above the bullish order flow while keeping the stop loss below the order flow zone. Our minimum target should be the most recent swing high or the major higher high level. In a similar manner, we can discuss the scenario for a bearish market structure. As you can see, the price has formed a bearish break of structure when it broke below the previous major swing low level. We can mark the unmitigated order flow zone here. Then, we will have to wait for a valid pullback to happen. We can observe that the pullback returned to test the unmitigated order flow. As in the previous scenario, two outcomes are possible. First, the price could just break past the order flow, resulting in no trade. The other scenario is when the price tests the bearish unmitigated order flow and reverse lower to move in the existing major market direction, which is bearish. In that case, we can look to take a short trade below the order flow after it has been mitigated while keeping our stop loss above the order flow zone. And our minimum target level should be the most recent swing low level or the lower low level. This order flow concept can also be applied to the minor market structures or in your lower time frame charts for the sake of taking short-term trades or for grabbing some quick points. I have marked out some bullish as well as bearish cases here. An important point to note is that if there are multiple unmitigated order flows formed within a major structure, then there is a high probability that the market will return back to the most extreme order flow while failing all other order flow areas. Or in other words, the extreme order flow zones have a higher probability of providing us with a successful trading opportunity. Now you can pause the video and take a note of the points mentioned, or else the video will get very long. I hope this will be useful for many scalpers and intraday traders who just wants to catch a few quick points. Now, there are a few drawbacks with order flows that all traders need to be aware of. First of all, stop losses will be considerably large. Since order flow is a zone or an area in the chart, we will have to place our stop loss beyond this zone or area. Even then, we cannot be absolutely sure that the price will not return to hit our stop loss. And because of a large stop loss, the reward to risk also reduces. The reward to risk provided by an order flow trading opportunity is lower compared to that given by an order block trading opportunity. Another problem with order flow is that there is no proper entry criteria. Entering a trade position from an order flow zone is mostly about our intuitions and reward to risk considerations. Yet another problem, which is committed due to human error, is the wrong identification and marking of order flow areas. If you make the mistake of marking the order flow wrongly, then most probably the price won't return to mitigate it, or sometimes it will even fail the order flow. Now take a look at this case. Tell me where to mark the order flow area. By definition, a bullish order flow is the last selling move before the buy. So if you follow this definition blindly, then we will mark this area as the order flow. But this is not the correct order flow zone. The area that we have highlighted